Welcome to the Accumulating Wealth Podcast. I'm Judson Crawford.
And I'm Hunter Satterfield. We are CPAs, wealth advisors, and partners at CWA, a financial services firm here to help business owners navigate the decisions they face every day.
Yep, and today we're going to discuss a recent update to what experts believe is the new worst case scenario safe withdrawal rate when you're planning for retirement.
And even if you're not nearing retirement, trust us, this topic is absolutely still relevant to you and will help guide your savings plan. Let's go.
Okay, so today, before we get into the topic we are going to discuss, we are going to reintroduce our guest who was most recently on the podcast talking about the OBBBBBBB.
Yes, it was big and it was beautiful.
It was big and beautiful, just like you.
Thank you.
You're welcome.
He's also fresh off his Texas A&M Aggies going into South Bend and winning a game against his second favorite team, the Notre Dame Fighting Irish.
A thriller, may I say.
Yeah, the Notre Dame holder pulled a Tony Romo and fumbled the snap. And
how much did you pay him?
Not enough.
Well, in all honesty, folks, Brian is an awesome guest as always, and he was fantastic on OBBBB. And so we immediately were like, we've got to have him back to talk about the topic that he is probably the resident expert on, which we teased a little bit, Judson, in the introduction. But in essence, for years, there's been this concept of something called a safe withdrawal rate. And before you tune out, listeners, trust us, this is going to be quite interesting and informative. Because here's the deal. This basically sort of sets the amount that you can, sort of pull out along the way from your retirement assets. And it's a really good sort of rule of thumb that you could use even now in your 20s or 30s to sort of gauge where do I need to get from a retirement savings standpoint. So again, Brian, you work with how many retirees now?
So I have 90 total clients and probably 60 to 65 of them are retired.
And perhaps, Judson, that's a good place to start because I think oftentimes you and I get the question of when I retire, like, do I stay with you? But we have a ton of retirees and we have continuing numbers that are going to retire here over the coming years. What is it, Judson, during retirement that's super important for us to still be involved in?
Well, I think we're going to answer a lot of those questions today, but I think the mistruth is that you get up the top of this retirement hill, and then everything's just easy after that, and there's no thinking, and you just get a check. But the reality is that your planning and retirement are just as important, if not more important, than the decisions you make pre-retirement, right? Because at least during the time where you're accumulating assets and you have income, you have the ability to make up for mistakes, right? Post-retirement, you do not have that income ability to make up for mistakes.
Yeah, I tell my clients all the time, when you're 35 or 40 and you make a financial mistake, you just work longer. You save more and you work longer. When you're 75 or 80 and you make a financial mistake, what do you do? And that's something that, you guys both hit on kind of the perfect thing to talk about. If there are any younger listeners here for this episode, you can't start talking about this early enough. You need to know how much you want to save each year and whether or not that's going to work because you want to know how much you're going to spend. And our good friend and partner, Daryl Kane, always used to say, how does the 70-year-old know how does the 30-year-old know what the 70-year-old wants? So, understanding what your normal spending is huge. And that's why we harp on all of our clients about their lifestyle each month.
And I think one of the things that we oftentimes at Judson and I have even started to see with some of our clients that have maybe sold their business or have reached retirement is sort of this emotional fear that comes with, because forever it's been, I just save and there's always a check behind. So no matter what, I'm going to be okay. But now for the first time, they're actually seeing their assets not increase as much originally and then eventually decrease, right? That's an emotional, strain on them, correct?
Yeah, I think you bring up the old cliche that I always tell my retirees is that retirement is 90% psychological and 10% financial. And I gave the old example that I still have clients that have been with us for 20, 25 years come up to me and talk about the gallon of milk. I gave the old example of the first day that you're retired, you go out and your spouse says, hey, can you stop by the store and buy a gallon of milk? And you walk out to your car and you realize you just spent $3 or $4 or $10, depends on where you live, of your life savings. And that really hits you because you've never touched your life savings. You've been trained for 40 years to not touch it. Just let it grow. And now all of a sudden you're having to not only touch it, you have to live on it. And it scares people. So,
Yeah. And I think, Judson, before you kick us off on some of the questions, I think one of the things that, during this time where we're working with clients as they accumulate assets, we focus so much on, taxes and what does inflation look like and what type of vehicle to put things in. And the reason we're doing that is we're sort of strategically setting you up to have the most success post-retirement, whether it's tax diversification or asset allocation or whatever else it is. And the thing is that post-retirement, a lot of those same exact things are also important. Like, what are taxes and what is inflation? And those things impact what account you pull from and in what order and when do you pull those monies and all of those things. And so I think the safe withdrawal rate that we're going to talk about today is a really good, helpful, high-level way to understand what you need in retirement. But man, there's so much more detail to it.
Yeah, there's a lot to it for sure. You look at, I tell clients all the time that when you're saving in a 401k plan right now, you're getting to take a tax deduction for that. And if you think Fed and state, on average, you're saving about 40% in taxes. And then the pushback is, well, yeah, but I got to pay those taxes when I retire. I did the calculation today. I actually had a consult with a retiree today, and we talked about what their tax rates are right now. And on average, they're paying less than 20%. And, if you can get a 40% deduction upfront with the time value of money and compounding, and then later in life only have to pay 20% or less on average, that's a grand slam.
It's a win.
Yeah.
Well, and I think one more thing before we jump into the actual numbers, when we talk about, for those listeners out there that don't feel like they're close to retirement, and we're talking about safe withdrawal rates, for our clients that are in their accumulation phase, we may not talk about specifically with them safe withdrawal rates, but when we run your retirement plan and we're calculating what you want to spend in retirement, we're running those scenarios to see if you're successful in a reverse engineered way. That's exactly what we're doing, right? We're making sure that you have enough so that when you get to retirement, you can safely retire. That's right. What we're talking about when we talk about safe withdrawal rate is once you're actually at that point and we know what your needs are, what percentage of your portfolio are you living off of? And so this guy that we're going to talk about today, this author and researcher, for years has kind of been one of the leading authorities in, what is a safe withdrawal rate. And he's come up with, what is a pretty big update. And I think it speaks a lot towards the way we work with our clients. And Brian, a lot of the things that you've done with your clients to prove out, what is safe and what can you withdraw, right?
Yeah. Originally when this author, his name is Bill Bingen, when he came out, his safe withdrawal rate was based on loads of studies and loads of data, but it used very few asset classes. It used stocks and bonds, and that was it.
And just U.S. large cap stock.
Correct.
It didn't have small cap. It didn't have international.
Exactly.
And I mean, to a certain extent, when he was doing this research in the 80s and 90s, and he was going back to the 50s and 60s, I mean, those are really, you and I are both on the investment committee. You're the head of it. Those were really, that was what people invested in.
Exactly right.
And now we have much more to invest in. So sorry to sort of
no, you're fine.
Out,
but I would say, his research was the whole purpose of his article and his book that he wrote to begin this, and he is kind of the preeminent expert on this topic, was what does it take? What can you pull out and never run out of money? In other words, I want a 100% success rate. And very few times in life and in our planning rooms do we ever plan for a 100% success rate.
Or what the words he uses is worst case scenario.
Right. Yeah. And so a 4% withdrawal rate, which is what he came up with to begin with in his initial research, never struck me right. And the reason it didn't, guys, is because you think of the average American retiring at somewhere around 62 or 65. So let's say 65. And you add 25 years to that, 65 and 25 is 90. Well, that's past life expectancy. And yes, we typically plan for our clients to live longer than that. But think about a 25-year horizon from 65 to 90. If you got a 4% withdrawal rate, you quite literally, you could dig a hole in your backyard, bury all your money, get a 0% return for the rest of your life, and you could still take 4% out every year, and it lasts you that long. And I've yet to find the retired client that's willing to take a 0% rate of return. You find that guy, let me know.
Yeah. And I think again, just as we double click into like, what is this safe withdrawal rate? I mean, in essence, all it is you take whatever your assets are at retirement, right? So whatever your Kane Waters planner or your financial planner has said, hey, here's what you're going to have at retirement. And under this rule, you would calculate 4% of that. And that's what you could take out every year and never run out of money. The concept is they would basically, the last check would bounce, as Daryl always used to say to us. And I think that's why you're saying that, right? Because if you've got $2, $3, $4 million, we're talking hundreds of thousands of dollars with no growth. Right. And that would last you 25 years. And again, that's just falls short. And so again, as we sort of go through this, he's since updated, and that's the impetus for this recording, right? He's since updated it. It's no longer 4%, correct?
That's right. So in his newest book, what he did is he took that original study, which, like we said, was large cap stocks and bonds, and he added first small cap stocks. Okay, small cap stocks being defined as
companies that are smaller than large. How about that?
Smaller than large.
Technically, they have 1 billion of market value or less.
That's right. So they're still fairly large companies, right? So he added small caps to it, and automatically that took the 4% rule to 4.5%. Okay.
And I think the reason there, Judson, is really just diversification, right? Because now you're no longer, again, if you think about listeners, like if you're only allocated to US large cap and US fixed income, anything that happens there creates that worst case scenario upon us, right? Versus if now you say, oh, I'm going to diversify into a different asset class, you get more certainty because you get a smoother overall return. So I thought that was just very intuitive that it would take it up. You said from 4 to 4.5?
4 to 4.5.
Yeah. And what's funny is when I first got here at Kane Waters 21 years ago, Daryl came to me and said, hey, we have all these clients that are about to retire, and we want to have a systematic roadmap to help them get down the mountain. And, I said earlier in this podcast that the 4% just didn't strike me right. So we actually did a lot of research, went back to look at all the data from Ibbotson on all these different asset classes. And our number came out much, much higher than 4%. And I say that it's came out to be like 5.2%, which ironically is now kind of what Bingen's saying when he added in all those asset classes. So, it speaks to what Hunter preaches to a lot about diversification, about rebalancing, about doing things like that actually allow you to spend more. So you think about that with a retiree. You have a $3 million pile that you're ready to retire on. And originally Bingen says you can only take out 4%. Not good with math, but that's 120,000, 10,000 a month. Okay. Now let's say you can do 5% on that same number. Now instead of 120, it's 150. You can spend 30,000 a year more, and that matters to people. That's a great vacation, more groceries, a nicer car payment, whatever. It's whatever you want to spend your money on, but it's things that really have an impact on your life's, month to month. And you don't have to stress and worry about your financial freedom of running out of money.
Well, and Bill actually said that very thing in an article that he was recently interviewed for, which was, he wanted to, he got to retirement a little over 10 years ago in 2013. And originally he wanted to basically do what he said. He was going to test out his philosophy. He said, I'm conservative. He said, I've also been preaching this for years. He said, this is what I'm going to do. And he said, he finally got to the point a handful of years ago after, the market had returned better than what he had put in his portfolio. And he was like, I am also increasing my, distribution rate up to, closer to 5%. He said, it's really nice. He said, it's really nice to have that extra. Right.
Yeah.
So when we're going back to what he did, he, after he added the small cap in, kind of Brian, like you were talking about, he then added in micro cap stocks, mid cap stocks, international stocks, and T-bills, got up to 4.7. I think again, what we're talking about, what we're talking about with the 4.7 is, in his research, under his 4.7, there was one scenario that didn't work. Okay. So he's calling this 4.7 his, his, what did he call it? His universal safe max. Okay. And his universal safe max, automatically basically passed for everybody in his study, made their assets last for 30 plus years, except for one person. Right.
Right.
What was interesting to me is that, it was not somebody that retired right when the Great Depression hit, right? Even though stock values went down. And why is that?
Yeah, the Great Depression had it was really not inflationary, it was deflationary. So things started costing less. Then at the very end of the Great Depression, the year or two right after the end of the Depression, the stock market went up by 47%. And it covered a lot of the misgivings of what happened in the stock market during the Depression. So that person that retired at the beginning of the Depression, it hurt. I mean, they lost a lot of asset value, but then it recovered pretty quickly. Where the person who didn't make it was actually in the late 60s, and the actual month that he looked at was October of 1968. But when you look at the late 60s, you have to think about economically what was going on in the world. We had this, hyperinflation, not the type of inflation that we've had here recently, like 9% that we had a couple of years ago. That's not hyperinflation. We're talking about 16 to 18% inflation with a stagnant economy, meaning it was not growing. You put those two words together, a stagnant economy and hyperinflation, you get stagflation. We don't have that right now. We're concerned about it, but we don't have it right now. And so when I talk to my clients, even though when you look over 100-year period of time, which is an amount of data that we have, when you look over 100 years, you can look at withdrawal rates that will fail a certain amount of time or a certain percentage. But if we're not in that economic environment right now, you probably even have a greater success rate. So those are some of the things that we talk about our clients whenever we talk about distribution rates.
And arguably now in today's world, we have more sophisticated investment vehicles. We have access to other asset classes that they didn't have in the 70s and 80s. Have a better understanding, right? Because of what technology has given us and a lot of things we've talked about on here, Judson, about our investment platform. As a result of that, I think even in that scenario, we're probably still okay. Right.
Yeah, absolutely.
And I think that just goes to like the way to effectively navigate the choppy waters and get yourself into the fives and maybe higher could be as simple as just really good diversification and investment management. Right.
Yeah. And you look at the statistics show over the last 100 years that if your withdrawal rate was literally like 5.2%, that you still have a greater than 90, and in most cases, depending on your allocation, a greater than 95% chance of success. So every 0.1% that you can give somebody, an additional distribution rate is more flexibility in their monthly spending. So
I think it's important. I think it's also important that we understand like the premise of this safe withdrawal rate, right? So, if you set your safe withdrawal rate and you feel comfortable at a 5% rate and you retire with $1 million, then your withdrawal in year one is $50,000.
That's right.
Okay. Now, some of the other things that are built into this is number one, a cost of living adjustment, right? So he did build in an annual cost of living adjustment. But what happens if in year one of my retirement, there's a downturn in the market and my investments go down to $900,000? Does that mean I then can only take $45,000 out?
No, actually it's already built into the analysis, the timing of returns. That's why we've gone back to look at over 100 years of data now. And, it basically bakes into the equation that you're going to have recessions. You're going to have negative returns, and those negative returns happen and then the market recovers. And so, no, it does not adjust how much that you have to spend on a regular basis. You can adjust. And, the psychology behind all of this, a lot of my clients, as soon as that first digit turns, if they have $3 million when they retire and all of a sudden the market goes down and they've spent a lot of money and now they have 2.9, you and I both know that that's not very different, but it starts with a 2 instead of a 3 and it freaks them out.
So would there be a good argument to say that during retirement, when the market is ripping quite well, you could do 6% or 7% as long as you're willing to, when the market draws back, to do a little bit less?
It's possible, but I tell you, the hardest thing is cutting back. People don't ever want to cut back. So that's why we talk about what is safe. And Judd, you mentioned a second ago something really interesting of when your clients retire, they start thinking of, hey, why do I still need you guys? Hey, I don't have a practice. I don't have a pension. What do I need you for? And it's more than just what if I make a mistake at age 75. It's looking at this safe withdrawal rate and what your goals are and what you're spending on. I have retired clients that come to me all the time and say, hey, one of the things I've always wanted to do was take my entire family on a cruise or do something, and is it okay if I do that? And when you can put it mathematically on paper to show that, hey, what you're doing is absolutely fine. to me, that's the most rewarding thing we can give to our clients, is that safety and security of knowing, hey, I can do something for my family that I've always wanted to do.
Yeah, one other thing that I thought was interesting, Hunter, and I thought you may have a thought on this, but when he introduced these other asset classes, right? So now we're up to 7 asset classes in his allocation, or in his analysis, and we get up to 4.7%. But one thing he said in this article was, he said, based on history, small and mid cap stocks in the U.S. have done very well, earning higher returns than large cap stocks, et cetera, et cetera. Then he said, I think maybe things have changed. Some of the best small cap companies now often get siphoned off by venture capital and private equity, and they don't become available for purchase by mutual funds or exchange traded fund managers, so that we're dealing with a smaller section of funds, and perhaps that may change things in the future. I thought that was interesting based on, and we've talked about this in the podcast, when we're dealing with, our clients' portfolios, and you and both of you being, and as the heads of really, our investment platform here, can you talk a little bit about what he's talking about there? And then maybe in our portfolio construction, how many different asset classes are we allocating clients out to?
Yeah, that's great. I think, and one of the things to think about with that is that his first original analysis, again, as I mentioned this earlier, Brian, was U.S. large cap and fixed income.
That's it.
And that was what most folks that were investing in, right? And we have a much more sophisticated market. We have access to incredible things at very low fees and whatnot. And so as he has sort of re-underwritten his safe withdrawal rate analysis, and he's like, oh, all of a sudden I'm into the 5s. You start to think about, well, all that really took was understanding that we now have exposure to these other things. And so what if an investment allocation did contain sleeves of private equity and private credit and real estate exposure and real estate debt exposure and small caps and international and tax loss harvesting and all the things that we have? You can absolutely have confidence over 5%.
Yeah, I would say, it speaks to why we preach on diversification, that you diversify and you have a lower volatility, lower standard deviation. The reason you do that is so that when we do have that pullback, that market recession, that you lose less. And by having smaller losses, the idea is that when the market does rip and the market does go up, that your pile did not get damaged as much, and you could sustain even more withdrawal rate. So ultimately, that's the goal here, is to try to protect the downside, clearly not eliminate it, but protect it, and allow our clients to have a better lifestyle than they thought that was ever possible.
Yeah. And I think one of the other things to add, because it's a great question, Judson, is like, we also now have, much more tax sophisticated vehicles that are out there, both on the investment side and then also on the savings side. Right. And so we mentioned earlier, for the younger listeners right now, you're like, why does this matter for me? It matters for you because, as Brian said, you can never start learning this too early to understand the nuance of how your assets are actually going to get pulled in retirement, and what you can do now to begin to build a really solid foundation, both on what vehicles you're in for tax purposes, but then also the types of investment decisions you're making for tax purposes as well. Because that is no question, even at a 20% rate, that is one of the biggest things. If we can have tax efficiency in our retirement assets, we can get that extra 1 to 2.
It makes all the difference in the world. Yeah. I mean, it's such a change in your lifestyle and your quality of life. So yeah, I mean, everything you said there, Hunter, I want to echo, is diversification matters. Having exposure to more efficient, different asset classes matter. But the reason that your planner, if you're 35 years old right now and you're listening to this podcast, the reason this matters to you is your planner is going to ask you about your lifestyle and really help you understand, so that what Judson said earlier is correct, that we can re-engineer what you're able to afford to spend and what you need to save in order to make that happen. So I really do appreciate you guys having me. This is kind of what I've built my career on, is helping retirees learn what is safe to live on. And I take it really personally, and I love doing it.
Well, to wrap up, I, as co-host of this podcast, have an apology that I have to make. I have ruined the day of my co-host because I took his new book by Bill B. and I highlighted in it, but I highlighted it in orange, one of his favorite colors. And I also highlighted the word opposing orifices for him to make sure about me.
Listeners, this is very important to understand. If you don't already know this about me, the spines in my books, first off, I only buy hardbacks. They don't get bent like you've been bending this the whole recording.
Well, it's been creaking. You could hear it.
They don't get highlighted in. They don't get marked up. And this man knows me so well, and he knows it would write. You even told Brian coming in, I'm going to highlight in his book, and he's
I said I highlighted in his book, and he's going to be pissed. Yeah. Is what I said. But I wanted to make sure I could refer to the appropriate sections for our listeners. It was for our listeners, and I will buy you a new farting book.
Gross.
Anyways, the best way to keep up with this is to subscribe to this podcast. That way you never have to miss an episode, and you can go back and listen to all the others. Enjoying it so far? Leave us a review. You can even tell us what college team you're cheering for this season, because we want to know. Seriously.
The Fighting Orifices.
The Fighting Orifices. Have a question, comment, or suggestion for a future episode? Drop us a line at canewaters.com/wealth. We really do answer these, and we love to hear from you. And if you want to learn more about what we do, and we're not recording these episodes, visit canewaters.com to see how we're helping our over 3,200 clients reach their long-term financial goals.